Canada is producing more oil than ever. So why does the Canadian still feel a robbery every time he stops at the station? That is the contradiction. A country full of energy, hitting production records, selling more to the outside, and even so without managing to transform this into cheaper gasoline for those who live here. And the most revolting is that this is not happening by accident. It is happening because the system was set up to reward the market before relieving your life. In the last months, Canada continued pushing its oil production upward. In November of 2025, the production of crude oil and equivalents rose 4.9% in relation to the previous year and reached the highest daily volume since the beginning of the StatCan series in 2016. In the same period, the production of synthetic crude also hit a record. And even with weaker international prices, the Bank of Canada registered at the beginning of 2026 that the expectation of the sector was of more production in 2026, supported by efficiency gains and by the already available export capacity. So it was for gasoline to fall, right? Wrong. Because the price of gasoline in Canada does not respond first to how much Canada produces. It responds first to the global market. And this changes completely the game. When oil rises due to fear of war, due to supply interruption, or due to geopolitical tension, the station reacts. When refineries stop, the station reacts. When the Canadian dollar weakens, the station reacts. The local production even matters, but it does not command alone the final price that reaches the driver. The barrel may leave Alberta, but the logic that defines your pump continues being international. And 2026 already gave a clear demonstration of this. In February, gasoline in Canada fell 14.2% in the annual comparison, but rose 3.6% just from January to February, mainly because of the increase of oil before the conflict in the Middle East and due to supply interruptions in some producing countries. In British Columbia, the monthly increase was even worse, 9.6% in only 1 month, pulled by lower supply amid maintenance and closures of refineries in the Pacific Northwest. Do you perceive the size of the problem? The country can produce more oil, but a refinery maintenance or an external shock still manages to hit directly the consumer's pocket. And this is the point that almost nobody explains properly. Oil is not gasoline. It seems obvious, but this detail changes everything. Producing more crude does not mean automatically producing more cheap gasoline. Between the well and the car tank there is refining, transport, blending, distribution, margin, and tax. If the refinery enters maintenance, if there is a capacity bottleneck, if the logistics tighten, if the fuel needs to travel long distances, the final price continues high. It was exactly this that appeared in the economic readings of the end of 2025 and beginning of 2026. Interruptions in refineries and oscillations in the derivatives market continued affecting directly the price paid by the consumer. Now comes the most uncomfortable part. The increase of Canadian production is helping much more the capacity to export than the promise of cheap gasoline inside the country. The Bank of Canada itself highlighted in January of 2026 that the expansion of Trans Mountain helped to narrow the discount of Western Canadian Select to close to $12 during most of 2025, opened more access to Asian markets, and raised the share of Canadian exports to outside of the United States from less than 3% to more than 9%. This is great for market access, for revenue, and for the strategic positioning of the sector. But it is not the same thing as saying that the common consumer will feel automatic relief at the station. In fact, the opposite of what many people imagine can happen. When the country manages to export better, Canadian oil becomes more connected to the international price, not less. That is, the production grows, the efficiency improves, the external access increases, and the internal price continues stuck to the global logic. This is excellent for a competitive exporting sector. But for the family that only wants to fuel the car without feeling guilt, anxiety, and anger at the same time, this changes much less than it seems. And there is one more detail that makes this story even more cruel. In 2026, the Bank of Canada itself registered that many companies in the sector expected a WTI around $60 in 2026, with global oversupply weighing on oil. In other words, not always expensive gasoline means that Canada is profiting from oil at high levels. Sometimes the sector even faces weaker international prices, continues producing by scale and efficiency, while the consumer remains subject to refining shocks, margins, exchange rate, and geopolitics. That is, not even when global oil is not that strong, there exists guarantee of real relief at the pump. And when the Middle East enters in combustion, the story becomes even more brutal. On the 11th of March 2026, the IEA announced the release of 400 million barrels from the emergency reserves of its member countries because of disruptions caused by the war in the Middle East. This type of measure does not happen because the market is calm. It happens because there exists real risk of global tightening. And when the global market enters in this panic mode, it does not matter if Canada is producing a lot, the local price continues exposed to the storm. This is the heart of the Canadian contradiction. The country produces more, exports better, gains efficiency, gains access to new buyers, maintains the sector resilient even with lower prices, and still the common driver continues vulnerable. Why? Because the Canadian energy system was not designed to transform each extra barrel into cheaper gasoline for the domestic consumer. It was designed to function within an integrated, global, and commercial market. And within this logic, the main objective is not to protect you from the price. The main objective is to maintain flow, margin, competitiveness, and market access. That is why so many people look at Alberta, see record production and think, so the fuel should crash. But the calculation does not close like that. What leaves the ground is one part of the story. What arrives at the pump is another. In the middle of this path enter the international quotation of crude, the type of oil, the refining capacity, the seasonal shutdowns, the regional distribution, the derivatives, the taxes, and even the exchange rate. And it is enough for one of these gears to move out of place to destroy the simplistic narrative that more production equals cheap gasoline. And there is a psychological detail that the public feels, even when it cannot explain. The price rises fast and falls slowly. When crude shoots up or the refinery locks, the pump reacts almost instantly. But when the pressures ease, the consumer rarely feels the same speed in the fall. This is what makes the subject so irritating. It does not seem only economics, it seems manipulation. And even when there exists technical explanation, the popular feeling continues being the same. The system always finds a way to pass the pain to you faster than it passes the relief. In the end, the great truth is this: Canada can be sitting on a mountain of oil and even so not offer cheap gasoline in a consistent way to its own population. Because wealth and resource is not the same thing as protection and cost of living. And while the country continues producing within a global logic, dependent on refining, vulnerable to external shocks, and organized to export with efficiency, the station will continue telling a very different story from the one that the production numbers suggest. So the next time someone says that Canada is producing more oil, so gasoline had to become cheap, the answer is simple: no, it did not have to. Not in this system, not with this market, not with this structure. Record production does not guarantee relief. Strong export does not guarantee discount. And abundant energy does not guarantee cheap life. This is the irony. And maybe this is one of the most honest portraits of the Canadian economy today. If you like this video, leave a like, subscribe to the channel, and comment what you think about all this.